Today, I'm going to reveal why 90% of the retail traders fail in option trading while professional consistently win. The secret? They don't just look at price. They look through a different lens called as implied volatility. Let's break it down. Understanding implied volatility is like understanding cricket. You can't judge a batsman's ability from just one shot. Let's take Virat Kohli. Do you judge him only by his score? Or how does he play under pressure against different bowler on different pitches? In option trading, it's the same. Option price alone doesn't tell the full story. You need to understand the market's expectation of pressure and movement. That's exactly what implied volatility tells us. Here is the difference between an average trader and a pro. The average trader will say the option price is high today. The professional trader will say the IV is low, this might be an opportunity. Let's take an example. Let's say Reliance option is at 100. HL option is at 50 rupees. Does it mean that Reliance option is more expensive? Not necessarily. Price alone doesn't tell you if the option is cheap or costly. We need a fair apple to apple comparison. That's where implied volatility comes in. It standardizes the option market, allowing you to spot the true value. Think of IV like a speedometer. So, for example, if a car is going at a speed of 120 kilometers per hour, you know it is fast, but you don't know if it is heading north or south. Same is with IV. IV doesn't tell you the direction. It only tells you how much price might fluctuate. If the IV is high, there could be big potential swing. If the IV is low, it will be calm, predictable price action. But again, it doesn't tell you if the stock will go up or down. Let's define IV clearly. IV measures the expected future volatility. It is expressed as a percentage, 30%, 50%, so on. It predicts how much movement, not which direction. If the IV is high, expect wild pricing. If the IV is low, expect tighter, stable price moves. Classic example, earning season. Before quarterly result, IV spikes. Why? Because trader expects something big to happen. But even when the IV is high, the direction is still unknown. Now the big question, how do we take advantage of IV? Most of the time, markets are efficient in pricing the volatility, but sometimes the market gets it wrong. That's where smart traders step in. Using tools like our terminal, we can compare current IV levels versus historical IV. When the current IV is too high or too low compared to history, it creates mispricing, and that's your opportunity. We will explore how to trade these mismatches in our upcoming 3 strategies videos. For now, let's lock in your learning with 5 quick questions. Question number 1. What does implied volatility measure in option trading? A. The price of an option. B. The future price direction of an underlying asset. C. The potential fluctuation in the price of underlying asset. Or is it D. The time remaining until expiration? The answer is C. The potential fluctuation in the price of the underlying asset. Question number 2. Why is implied volatility important for option traders? A. It predicts the direction of the stock price. B. It helps determine if an option is cheap or expensive relative to its historical pattern. C. It gives an accurate forecast of the stock price. Or is it D. It helps in predicting the next earning announcement. The answer is B. It helps determine if the option is cheap or expensive relative to its historical pattern. Number 3. What does high implied volatility indicate about the market? A. The stock price is likely to remain stable. B. The stock price may fluctuate dramatically in either condition. C. The stock price will definitely increase in the price. Or is it D. The option is overvalued? The answer is B. The stock price may fluctuate dramatically in either direction. Question number 4. What is the main difference between the average traders and professional traders in terms of implied volatility? A. The average trader focuses on price whereas the professional focuses on IV. B. The average trader uses IV to predict direction. C. The professional traders ignores IV. Or is it D. The average trader predicts future volatility? The answer is A. The average trader focuses on price while the pro focuses on IV. And here comes the last question. Question number 5. When does implied volatility tend to spike? A. When the stock price is stable. B. Before quarterly result announcements. C. When there is a little news. Or is it D. After a stock price increases? The answer is B. Before quarterly result announcements. Share your scores in the comments. I'll personally review and help you guide towards taking the next step. If you found this lesson valuable, share it with someone who is still trading options without understanding implied volatility. In our next video, we will explore skew, how to use them to identify the mispricing. Until then, keep learning, keep winning.